Over the past several days, a noticeable pattern has emerged across global financial markets. Investors from different regions, including institutional clients, high-net-worth individuals, and experienced retail participants, are reporting similar conversations with their brokerage firms. The message is consistent. Brokers are reaching out proactively, not to promote new products, not because of margin stress, but to discuss risk in the silver market. For seasoned investors, this is unusual. Historically, brokers tend to make contact only under specific circumstances: administrative needs, portfolio rebalancing, or compliance-related events. They rarely call to provide timely market guidance, especially during strong price trends. Yet this week, calls are happening in volume. Many of these conversations are directed at long-term silver holders, investors who accumulated positions years ago, held through periods of stagnation, and are now sitting on substantial unrealized gains. The recommendation being shared is not simply to consider profit-taking. In some cases, clients are being encouraged to explore downside hedges, including short positions, put options, or inverse products. The language used is notable. Instead of measured terms like volatility or temporary pullback, more severe phrasing is being introduced. References to forced selling, liquidity events, and sharp corrections are being emphasized. Naturally, this creates concern, particularly for retirees and conservative investors. So let's pause here. When market narratives shift suddenly, the most important question to ask is simple: who benefits from this message? Financial institutions do not typically act out of concern for precise market timing on behalf of clients. When similar assets traded at much lower levels in the past, caution was minimal. Now, after a strong multi-year performance, urgency has appeared. That contrast matters. To understand what is happening, we need to separate emotion from mechanics. The role of the Bloomberg Commodity Index (BCI) at the center of this discussion is a scheduled and well-documented event, the annual rebalancing of the Bloomberg Commodity Index, often referred to as the BCI. To many investors, this index appears abstract, just another benchmark. But in practice, it is one of the most influential commodity allocation frameworks in the world. Large pension funds, endowments, and sovereign investors use it as a reference point. Its design is rule-based and passive. It does not react to news, opinions, or forecasts. It follows a calendar. Once a year, the index adjusts the weight of each commodity to prevent any single asset from becoming disproportionately large. This process is mechanical, transparent, and widely anticipated. For the coming cycle, silver's target weighting has been reduced modestly. On the surface, this sounds bearish, but the reason behind the adjustment is often overlooked. Silver's weighting increased not because of new allocations, but because its price rose significantly relative to other commodities. As a result, its share of the index grew beyond predefined limits. The rebalance is not a judgment on silver's fundamentals. It is a response to its performance. Understanding the $6 billion figure, some analysts estimate that this rebalance could require several $billion worth of silver exposure to be reduced across index-linked products. That number is real, but context matters. Index rebalancing does not mean that physical silver is being dumped onto the market. Most of the adjustment occurs through futures contracts. Trades are often staggered, anticipated, and partially executed well before the official rebalance date. Professional managers do not wait until the last moment. Once target changes are announced, institutions begin adjusting gradually. This process can take weeks or months, and often coincides with periods of strong liquidity. In many cases, the majority of the selling pressure occurs before the rebalance window opens. This is why markets often consolidate ahead of known events, not after them. Paper markets versus physical demand. Another critical distinction is between paper silver and physical silver. Paper contracts can be created and traded rapidly. Physical silver must be mined, refined, transported, and stored. At times, prices in paper markets diverge from conditions in physical markets. Recent data shows persistent physical demand in Asia, particularly through Shanghai, where prices have traded at premiums to Western benchmarks. When such premiums exist, Arbitrage naturally draws metal toward regions where demand is strongest. This mechanism can absorb temporary selling pressure efficiently. What this means for investors, this situation is not evidence of an imminent collapse, nor is it proof of guaranteed upside. It is a reminder that markets operate on structure, incentives, and timing, not just headlines. Index rebalances are routine. Short positions exist in all asset classes. Volatility around known events is normal. The key risk for investors is not the rebalance itself, but reacting emotionally to incomplete narratives. What we are witnessing is not a sudden breakdown in the silver market. It is a technical adjustment being framed dramatically. Understanding the mechanics helps separate signal from noise. As always, this is not financial advice. It is an explanation of how the system works. If you found this analysis useful, consider liking the video, sharing your thoughts in the comments, and subscribing for more calm, fact-based financial documentaries.